I'm an optimist. I think that technology and AI will help us. Like if people are like, oh, they're going to take our jobs. Like people want to talk to people. People will always want to talk to people. People want to have their guide, someone that knows them inside and out. They want a personal relationship with them. So I think what it will do is make us better. I think it will take away the minutia and allow us to spend more time on the client.
Hey, everybody. Welcome back to another episode of The Connected Advisor. I'm your host, Kyle Van Pelt, co-founder and CEO of Milemarker. And today I am joined by Scott Colangelo. Scott is the chairman and managing partner of Prime Capital Advisors. He's also the creator of Qualified Plan Advisors. He is a forward-thinking innovator and visionary in this space. He has done some really incredible things in the wealth management space, and I think we're going to have a truly insightful conversation today. So Scott, thanks so much for joining the show.
Yeah, thanks for having me. Absolutely.
So here's my first question for you that I've just been morbidly curious about for a long time in this industry. So
I'm nervous.
You're based in Overland Park, Kansas. Creative planning is out there. Mariners out. There's lots of what makes Overland Park or greater Kansas City such a hotbed for the wealth management industry?
Yeah, it's really fascinating. If you look at industries, like I have clients that, process dog food down in Sabetha, Kansas. And it's funny. There's one company that was the first company and like 4 or 5 employees left and started competitive companies. So they all had their roots in one company. There was nothing like that. We all just sort of we all organically decided to get in this space and there was no overlap. We don't have like this executive went there and started this one. It was, Peter Maluk at Creative has done a fantastic job with that company. Marty has done an amazing job over at Mariner. They use different models. Peter's more like, has a really set process and has a really high end structure that's extremely efficient. Marty's, more like, hey, we're going to buy them and let them continue to run their business how they see fit. And, it plays to different audiences and they're both wildly successful. We're probably somewhere in the middle there. And then you also have one digital, which, they're 401k resource. I think it used to be called, it was BKD's retirement practice before One Digital bought it, and they're more on the retirement side, but they've gotten into wealth. So Lockton was actually ended up their retirement side was purchased by Creative. So you have these, it's a really fascinating thing because honestly, out my window, if I look to the right, Marty's right here. And if I look across the street, Peter Maluk's right there. I mean, it's like we literally could throw a football at each other's buildings. So yeah, it's funny. Yeah.
Everybody knows about Wall Street. People don't know about, I don't know what street it is where you guys
College Boulevard.
Nobody knows about College Boulevard, Scott. The real hotbed of wealth management in the United States of America.
I know, right? It's a crack up. And the funny thing is we're all competitors and everyone's good, just good group. I mean, everyone's cool. We all get along with sound. So it's neat. Yeah.
Yeah. Well, I mean, that makes sense to me, though. I mean, if you look at the demographics and stuff, there's not enough planners, for the amount of people who need advice right now anyway. So I think the pie is plenty big for everybody. Yep. And that's one of the things I love about our industry, actually, is the collaboration that happens even amongst really large, successful firms. Nobody's viewing it like, hey, this is all of our, turf and trade secrets. Like one thing that always really fascinates me is people like the names you've mentioned, they tend to be like in a study group together, right? They're all just sort of saying, hey, can you share what you're learning? We'll share what we're learning. It's a very open-handed approach to the industry and the business.
Well, it is. And you have to remember, like, there's a trend going on, like not a lot of people are talking about. I've been trying to get this message out, but the New York-based investment firms never really cared about the RIA space. And for 25 years, they were selling products and were sort of on a gravy train of selling solutions to endowments and pension funds and things like that, because those 25 years ago weren't doing non-traditional assets and things. So, and they started to, as their investment policy statement said, okay, yeah, we're going to use some because it reduces our risk and increases our return, and we'll do 5%. Then it went to 7%, 10%, and over the last 25 years. But as of late, that's kind of maxed out across the board. Everyone's at 25, 30%. And so in the meantime, they're looking at the RIA space across the ocean. I call it the Great Divide, and they're small shops. Well, 5 years ago, there was 10 firms with over 10 billion. Today, there's over 75 5 years later. And so all of a sudden you see Goldman hiring 100 people, to sell into the RIA market. Morgan Stanley brought in 92 billion of new assets. I think it was third quarter last year, and 67% of them came from the RIA space. So you say that, and we all do get along. There's plenty of business, but we might want to think about doing business together and helping each other's organic growth and collaborating. I think there's a way for us not only to be competitors, but to be collaborative and I don't want to call it a consortium, but work together and offer services. Because listen, I guarantee you there's things Mariner's doing better than us. I guarantee you there's things that, the creative's doing better than us. And I guarantee you there's things we're doing better than them. There's got to be opportunities for us to cross collaborate and kind of juice our own organic growth as opposed to sending business to New York,
Yeah, man, that's well said. 92 billion in assets that's a really big number. That's like kind of crazy to stomach when you think
in one quarter.
Yeah, in one quarter.
That's nuts. Yeah.
Well, and I mean, listen, let's talk about that a little bit, right? Because I know a lot of the RIAs in this space love to tout, hey, I'm taking business from wirehouses all the time, right? I'm taking business from the wirehouses. But to your point, maybe they weren't paying too much attention to, this is going to sound harsher than I mean, but the crumbs at their table. And now all of a sudden they're looking and going, well, we can take business back from that RIA space just as much, because 92 billion, that's a lot of business.
And I think that what they're doing is the assets are staying at the RIA. I mean, most RIAs have extremely high client retention, but they're using products and solutions that are built and designed at the big shops. And I don't see why we can't build and design them ourselves. And we've done that ourselves. We launched a strategy with Goldman, I don't know, just a few weeks ago. It's a CUSIP-based solution that could be used by anybody, right? And so I think that and it's more efficient, it's more effective, it's easier, it's more, you can jump from platform to platform, from custodian to custodian. So there are ways that we can get more efficient. There are ways that we can bring products and solutions to market just like they can. And the funny thing is we have the ability to seed them with our client money. You got to do it properly and everything, but we have the ability to make them successful out of the gate, where a lot of times they launch product and they're like, well, we think this will sell. So we actually have some leverage and some advantages that they don't have. And I think that there's opportunities for all of our firms to consider working with each other in certain areas. I'd rather send the business to Peter, one block from me than I would to New York. And so we have to figure those things out. And we're a wildly immature industry. I don't mean that derogatorily, like people are immature. That's not what I'm saying. These are very smart people. We're a young industry and we haven't figured out that, listen, Goldman, Merrill, Morgan Stanley, they all do business together all the time, even though they're big competitors, even though they don't like each other. That's part of the game. They do business to each other. It lifts, rising tide lifts all boats. RIAs do not do that. RIAs are wildly defensive about their practices. They don't use each other's solutions and stuff like that. We have to get over that as an industry.
That is a really interesting take. I'm glad we started there. My kind of joking question about everybody being in Overland Park has led already to an insightful conversation. I mean, I take your point about it being maybe not as mature as far as age and all of that stuff. Yeah. Also the fragmentation. Do you think that's a big deal too? Right. I mean, there's, 5-6 really big firms in Wall Street, who to call. Whereas for us, I mean, there's, 15,000 RIAs that you could call or whatever. And maybe people just don't know.
It's a really great point. I think you're spot on. I do think that the fragmentation, and listen, companies like Creative and ourselves and Mariner and others that are growing through recruiting and M&A and organic growth, as they get bigger, that does give us more opportunity. I think that we have this mentality of open arc, we're a fiduciary, all that. And it's like, oh my God, we can't create product. That's so counterintuitive. No, if you're going to do these services, think about it like this. We use 6 or 7 different custodians, okay? So if I have a strategy like XYZ strategy and I don't quote unquote create a product version, I have to trade that on 6 different platforms. I'm managing 6 different strategies and I'm not getting the buying power I would if it was one CUSIP and it was doing the same exact thing I was before. And now it's trading on all platforms instantaneously when I place the trade within that product, as opposed to placing trades on all those platforms. So there are simple ways for us to grow this industry, to grow our practices, to get more efficient, to scale better. And you can still be just as good of a fiduciary.
That's really well pointed out. So I don't know, that brings up a question I have. Before we hit record, you used a phrase about Prime that I think you called it intentional flexibility. Was that the phrase that you use about?
Intelligently flexible.
Intelligently flexible. That's what it was.
Yeah.
And I want to talk about that as it pertains to open architecture for firms, because I think open architecture was this wonderful idea that helped people go independent. It helped you be able to make choices. It helped you be able to do all of that. But one thing I've often wondered, especially from the technology side of things, is maybe one of the advantages that the wires have is they're not open architecture, right? Like they kind of have their technology stack. They do things the way they do it. Everybody has to kind of come underneath one process. Open architecture can create a lot of difficulty operationally, right? It can create operational drag because you've got, all of this overhead and things like that. How are you able to kind of do the intelligently flexible thing while, letting people choose what they want to choose, but not, but still being efficient and growing efficiently?
It's a balancing act, to be honest with you. There is simple things that just aren't up for debate. Like if someone's going to join us and they're like, I have to use Redtail, we use Salesforce, and they all do the same thing, and we're going to use Salesforce. You know what I mean? If you accounting, I have to use this accounting. We're going to handle the accounting. We're going to do HR. So there's certain things that it's like we're not flexible on because it's just counterintuitive. If it's not something that's going to help tell your story, save you time, or give you more resources for your end user and client, let's scale that side of the business. On the side you're talking about, you don't want to scale everything. That being said, most of the things being used by advisors are most of the things being used by advisors. So in other words, if you use nitrogen or Riskalyze, there's a lot of them using it. So as you get bigger, you're going to get pockets of people that you can still have scale with, right? So if you have 300 advisors and 50 of them are using Riskalyze, well, 50 gives us an ability to negotiate with Riskalyze to get better pricing, right? And to get better services and better support. So it's sort of like eMoney or Money Guide Pro. A lot of those are kind of the two most people are using now. So we probably have 50% of our advisors using eMoney and probably 50 using Money Guide Pro. We're still big enough that we're still going to get scale and still going to get better resources, pricing, all those things, and provide them support, like people that can provide entry and different things like that. Because if we can save money on the software itself, then maybe we can hire people to help them do the work too, help them make more money and be more efficient. So yeah, listen, it's a great question, and it's something that as you get bigger, and as you get more scale, and it's really scale's the name of the game. If you're going to have accelerated sort of J-curve type growth, but you also have to be mindful that you want people to be able to tell their story. You want people to be able to run their practice how they want to run their practice, because this is a lifestyle industry.
Yeah, no, I like that. Yeah, it's one of the reasons why Milemarker kind of came to be is like we just were looking across the industry and we said, every RIA has to do 80% of the same things, right? You've all got to do RMDs. You've all got to do client reviews. You've all got to open accounts. All of this stuff is the same, but there's that 20% that makes the firm unique, that makes them, that differentiates them. And it's kind of try to be a reflection of who you are as a person, because really at the end of the day, you're selling yourself, you're selling your trust, you're selling all of that stuff. And it's like, how do we help you scale? I love the way you put it. Like certain things are what they are. And it's like, that's not what makes you money. It's just what you have to do to be in the business. But then how do you show that differentiation on the other side is a really great way of thinking about it. And I'm sure that message resonates for people who are looking for a home for their firm, right? It's like, who's going to let me still kind of be uniquely me?
Yeah. Think about it like this, like anybody that's going to get caught up in, oh no, I have to use this software for our accounting, we don't have time for that. You know what I mean? Like if that's what they're worried about, the advisors that come to us and like, hey, how can I enhance my client experience? How can I free up time? How can I do this? Those are the people you want to, work with. And so, listen, it's interesting. People don't realize that even mild headwinds make life extremely hard, and you want as many tailwinds as you can have, because it's hard enough. Life's hard, not just business. Life's hard. Everyone's got kids and problems, and I don't need headwinds at work over stupid issues. We just don't have time for it.
Well said, man. Well said. So I want to take a step back to get us to where we are today. So this is a question I love to ask everybody. Some of it's more a personal curiosity, but I think the audience loves it too. So what I've found is some people have a traditional path to this industry. Some have an untraditional path to this industry, but everybody has what I call a money moment that caused them to say, this is what I want to actually do with my career. Out of all the things you could do in the world, I've found that almost everybody I speak to had a moment in their life that caused them to say, I want to go do this. I want to go help people with, manage their wealth. I want to help them with their money. So Scott, for you, what was that money moment in your life that was the change where you said, this is what I want to do?
Yeah, I knew I wanted to be in this industry because when my grandfather died, my grandmother got a pretty good life insurance policy and should have been set. And she worked with a bad advisor, and the money was gone in like a few years, and she ended up living extremely poor. She lived very poor. My family, my dad, and at the time, was doing well, but not well enough where we could support everybody. You know what I mean? And so it was tough for her. She never complained. She's from Portugal. She was awesome. Just a strong lady, lived to 97, just a fantastic, the strength of the family. She was sort of the rock, but it did break my heart. I always remembered that. You have other influences along the way. My dad ended up in this space, more on the P&C side. He was on Nationwide Insurance and did car and auto and all that, but they did mutual funds and annuities. And so, I had a little bit of exposure to it, but more than anything, it was that's the thing that, it's funny. No one's asked me that question, maybe ever. I don't even know if I've ever told that story about my grandmother.
Oh man.
Something like this. Yeah.
That's why we do it. That's an incredible story, man, because I've found almost everybody has something like that. And I love that you shared that, because like this industry sometimes can get a bad rap, right? Certain products get a bad rap, and it's because of stories like your grandma has. But, I have found that a majority of the people I talk to are trying to change that image, change that perception, do the right thing by clients who get that life insurance payout and stuff. And I appreciate you sharing that.
Listen, there's far more people that are trying to do the right thing. So I don't have a bad image of the industry. I get upset when I see bad actors, but there's always going to be bad actors. So
totally. Back when I worked at Riskalyze and Nitrogen, we had this wonderful partnership with First Trust, and Jim Bowen, I used to go hear Jim Bowen talk all the time. And I just love, he opens almost every talk with, this is a noble profession. Like you all are noble advisors doing a noble thing. And I love that, because there's so many other people who aren't saying that. So I always thought that was a really cool message of, yes, of course there's bad actors. Of course there's people doing wrong things, but this is a noble profession. You all are doing noble things. So I love that, man. All right. So you get into the industry, you kind of start growing this business. My research shows that a while back, you made a promise to your advisors that you would get them ownership in the firm. And it looks like in 2021, you were able to make that a reality. Why was that important to you? Why was that such an important promise to Scott?
Well, one, alignment is everything. So I'll share a little more about that. But yeah, we made a promise. But to answer your question more directly, I made the promise, so I wanted to live up to the promise, and it was me and another individual, Tim, that kind of told everyone that when we bought the firm. It was interesting because when we hired our CEO's unbelievable. I serve as our chairman, but really the credit goes to Glenn Spencer. Glenn used to be CEO at Lockton, helped them grow to as big as they were, and he's been doing the same with us. He's just a real talent and one of the hardest working people I've ever known. But I remember when we hired him, I was like, Glenn, we need to get everyone ownership. I want everyone to have ownership there. We care about him. We made a commitment to him, all that. He's like, Scott, he goes, we're doing 20 million of revenue and we have 20 million of debt. I don't think that you want it. He goes, if you give them ownership now, you're just giving them debt. So I was like, okay. So, we had a plan and, things have changed. We're wildly profitable and, revenues are many, many times higher than that now. And a lot of that's due to Glenn's leadership. And so, but when we had a 5-year plan and we were like 3 years into the 5-year plan, he's like, I think we can do it now. I was like, you do? He's like, yeah. So we did a road show. We went to every office. We did 27 cities in 3 weeks, and we sat down with everybody. And it was emotional. It was a really cool process, probably the highlight of my professional career. And now to go back to the reason and the concept of alignment, people talk about it, but they don't live up to it fully. If you think, I saw this thing, it was a while back. I think it was the British rowing team or something. They finished last. They made the Olympics, but then finished last, and they're like, we're going to win next Olympics. And brought in this guy who kind of was like, okay, we got to get 1% better every day. But he talked about how, I'll never forget the story. It left an imprint on me. He's like, if we're all rowing at 100% and one person's rowing at 99 on this side of the boat, we're eventually going to do a big circle and end up back where we started. And I just thought that was so fascinating. So when we did the ownership agreement, our attorneys were like, you guys need to have special rights. You're the founders. You need to have special this. You need to, get a preferred status, all this. And I was like, no. We are going to sign the same agreement. So we all signed the same agreement. Everybody. I've showed it to advisors. Like, I have literally the same agreement that you do. The only difference is I vote my shares for my shares. You guys vote as a group, just because they didn't have as much ownership. We're trying to give them more clout is what we were doing. But either way, everything economically, everything that we get, no special status if we sell, there's nothing. We have the same exact agreement. And I know that our competitors aren't doing that. I just know. And I also know that most of our competitors don't have 80+% of their company owned by the advisors. And so, especially for firms our size, you can find smaller firms that do that. And we're proud of it. And it has created a massive tailwind, We're all on the same page. People aren't like, hey, I brought this partnership to you. I want to get paid on it. No, we're all adding value to our share price. We're all adding value to the organization. We're all partners. You know what I mean? It's great having a partner meeting instead of a employee meeting. You know what I mean? So it's been great. We have we have a lot of key staff people that are equity owners. I mean, it's been a wild ride since we did that. It hasn't even been 3 years yet. So
that's incredible.
This podcast is brought to you by Turncast. We make game-changing content for fintech and financial services companies. Learn more at turncast.com.
I just want to double click on this a little bit, but I think that sounds counterintuitive to a lot of people out there, right? Entrepreneurs are like, hey, I took the risk. I came and, I did this and this is my blood, sweat, and tears and all of that stuff, which listen, I can appreciate. Like, I understand that mentality, but It sounds though like, one of the other sides is it's always difficult to get talent that sticks or, all of these types of things, right? There's kind of a revolving door at a lot of firms. Do you think that this has helped provide that type of alignment where people like they feel that sense of ownership, so they're treating it more like it's their own rather than working for somebody else? Or
100%. It's not even. I mean, we were always good culturally, but I never thought, oh yeah, we can get 10 times better culturally. We have. And you got to understand something. It's not just the ownership structure. Glenn, our CEO, when he came in, he said, this is going to be a company run by the advisors. So we have committees. We have a wealth committee, a retirement committee, a marketing committee. And those 3 committees set the priorities. And then it's Glenn and the executives team's job to execute on. So they say, hey, we want to go this direction. Here's why. Then it's Glenn's job to execute and his team. So literally all the priorities within the organization, all the changes in the organization, anything we do, any new growth initiatives come from our advisors. Our partners tell us. So it's not the other way around. I'm not picking our competitors. I think they all have great business models, but almost all of them, it's like top down. I make the decisions. Here's what we're going to execute. We're bottom up. The advisors tell us what they need, what they want to accomplish, what areas of the industry we need to get better at, whatever it is. They set the priorities. They each give us 3 a year, then we execute. So
wow. So since we're talking about culture, one thing I'd also love to ask you about, and the research the notes show, probably taken from some of the great business books and stuff out there, but you've actually implemented it. You guys have a no jerk rule and a no ego rule at Prime. Would love to hear you talk about that a little bit.
Yeah, it's we actually refer to it as the no a-hole rule. Can I say that? Yeah. So it's just, and then it was funny because we have meetings and we joke it. We don't have to say it anymore. We first, rebranded as Brent Capital, and we kind of set the culture. We're like, okay, remember, everyone, leave your ego out there, and we're all equal in here. I'm going to make mistakes. You're going to make mistakes. Like, it's okay. Like, let's talk about it and figure out how we're better next time. Like, everyone's so worried to be wrong, or to be right. It's like, who cares? Let's just get better. No one's better than anyone else. Every single human has the same challenges every day. And it's like, let's, as an organization, put aside the petty crap. I mean, our whole country's caught up in petty shit today. You know what I mean? Excuse my language, but it is. And it's like, let it go. 99% of everything we probably all agree on. We get caught up in these issues that are just mind-boggling. And so I think that, we do. And Tim, one of our partners in the firm, always says he calls it the Thanksgiving rule. He goes the more positive side. We go the negative side, call it the no a-hole rule. But it's like, he's like, if they're in town and they didn't have any family in town, would you invite them to Thanksgiving? He's like, if you say yes to that, then let's recruit them. You know what I mean? So would you want them sitting at the table with your own family? So, and it sounds silly, but those things matter to people when we're recruiting and we're doing, we're competing on M&A, and you share anecdotal stories like that. I mean, it does matter, and it is true. That's how we operate. We literally, when we bought the firm, there was 2 people that no one liked, and we all talked about it. We're like, these 2, when we didn't fire them, we said they'll deselect themselves, because that type of culture wasn't going to be accepted. And so we were just everyone's positive, everyone's rolling the same way, and you got these like squeaky wheels, and they just finally eventually go away.
Man, that's cool. I love hearing that. This has been a really fun podcast for me so far. I love hearing these stories. I love hearing about your firm. Continuing on that, healthy culture. But you've also said that there are 4 parts to a healthy firm. It's wealth, it's retirement, it's education, and it's product production. I'd love to hear you talk about that. I've got some follow-up questions on that. But where did those 4 pillars of a healthy firm come from?
We started as a wealth organization. I had a client that asked me to handle their retirement plan. I told them, I was honest, man, I know enough to be dangerous about retirement. This is back in 2000. He's like, I don't mind if if you want to do it, we'd like to have you do it. We trust you. I said, well, there may be some bumps in the road. And I ended up taking over their plan and setting up. It was at a record keeper, I won't say who, and they hadn't seen anyone in 17 years, he said, since they set it up. So I said, okay, well, I'll do it. So I call his head of HR and set meetings, 3 weeks of meetings, so a couple hundred employees. I'm like, okay, and I was going to go meet with everyone. And he calls me, he finds out after I scheduled the meeting, his name was Peter. He's like, what the hell are you doing? That's not the word he used. I was like, what do you mean? He goes, what are you doing scheduling all these meetings with my employees? I'm like, I need to. I thought the know your customer rule from the wealth side applied to retirement. That's how dumb I was or how moronic I was. I mean, I really had no idea. I was like, I just thought I had to. I mean, it seemed logical to me, right? I mean, it actually should be a rule, right? In the retirement industry, it'd get rid of 99% of our problems in retirement. But either way, I just assumed I needed to know their goals, their investment experience, their how old they are, their risk tolerance. It just seems logical. So being with Riskalyze in the past, I mean, that's just logical. So he's like, well, if you want to do it, do it. And it changed the course of my career. Ended up meeting with the participants. I still remember they had under 30% in participation. The average deferral was under 3%. And I went and met with all of them, and we ended up with over 80% participation. The average deferral rate was just under 8%, like 7.9%. I remember flying back on the plane going, God, I work with wealthy clients, and we're good. Maybe we get them 0.5% return better. Maybe, I don't know, maybe we get the same return with less risk. I think we add value, but I'm never going to have an impact on their lives like this. And I just had this conversation last night. It's so funny you brought this up. And I believe to this day that there's a whole bunch of those people that have a lot of money in retirement right now because of those simple acts we did in 2000, right? 24 years ago. I mean, I guarantee there's several people that have well over $1 million in their retirement now because of it, and I'm not saying that to pat myself on the back. I'm saying that because I'm proud of it. And I think that's how we went from wealth and then to retirement. And then as you get retirement plans, they have ongoing needs and concerns. It's not just, oh my God, we got to help these people. This is a business. This is a for-profit entity. We also can make money helping them, and that's okay. And no one wants to talk about it, right? I mean, help these participants. They're going to go buy their insurance from somewhere. They're going to invest other money somewhere. They're going to do their college funding with someone. Build a relationship with them. Have it in one spot. So now you're dealing with wealthy clients. Now you're dealing with retirement plan sponsors and committees. Now you're dealing with participants, and you have like a three-legged stool. What we learned the last several years, what I was talking about, is that these big firms are going to come in and start selling product to our side. Like, let's create our own to get more scale and efficiency, and also to keep the business in the RIA community. So, I think there's really sort of those four legs to this stool, and that's sort of the journey that I went on and others went on to get there, just so you know.
Yeah, that's really cool. Let's talk a little bit about education. I think it can often be under prioritized in the space, but also I have this benefit of sitting in this seat interviewing a lot of people, and it just seems like one of the common characteristics of the fastest growing firms is that they are high educators, right? They are just trying to be as teaching as much as possible, educating as much as possible, and then educating at scale. Why have you made that core to what you're doing? Is it because you think it helps bring in more business? Is it, I don't know, just talk a little bit about that.
God, there's so many reasons. The story I tell the plan sponsors when I talk about education or wellness, because they're similar but different too. When I'm in the committee and I'm competing for business, I say, listen, I want you to imagine you can see your front door, and every employee is walking in that front door every day, and they have a backpack on. And in that backpack are various different weights. And those weights are the stress in their life. Some of them you don't even know, they have a sick mother at home, and they're trying to work 9 to 5, and they're trying to help, they're trying to save for college. Maybe it's just that they're afraid of the fear that Social Security collapses. I mean, that's one of the biggest concerns. We do a lot of surveying with participants when we take over a plan. And I say, you're not going to solve it with a one-time education. And you're definitely not going to solve it with a fintech. I mean, I try not to laugh out loud when I hear people saying, our solution is a fintech. I'm like, no, please. Those are wildly unsuccessful, and no one uses them. We tell them, you have to get in front of them, and you have to survey your participants to find out what those concerns are. So our approach to education and wellness is this. It's pretty simple. We survey them, ask them a ton of questions. It's simple. It's a link. We bring iPads in the room. They click the link. They're live. They answer some questions. It compiles the data, and then we go show the plan sponsor. 82% of your participants are concerned about Social Security. Let's get that weight out of their backpack. The second one might be budgeting, or it could be Medicare, whatever it is. We let them dictate to us. I find it's just so comical to me to see these programs, this is how we're going to do it. Okay, well, you're going to do it, and that may not even be their concerns. Let them tell you their concerns, address them, and over time, I can't tell you how many plan committees have said, I can't believe this, but you're right. They're less stressed. I'm like, I know, because you're actually addressing things, and it doesn't happen overnight. It might take 2 years to get to a lot of the big issues with them. And those are really important. So why do you do it? One, it feels good. You are helping them. They're going to be more productive employees. So the plan sponsor loves it. I will also tell you it's good business. I've had plans that like a new CFO came in from a prior company. He's like, I'm going to use my guy. We're going to move past you guys and we're going to use someone else. There's like an uprising with the employees. Like, no, that's not going to happen, because literally we have relationships with like 80% of the employees. Our people, I'm always amazed. I'll go do like a committee meeting with one of my, advisors or something. You'll walk down the hall and they're like, hey, Brian. Like everyone knows them. It's like, you're not moving the plan, that's just not going to happen. So because of that approach, we've had private equity come in and like buy companies, and there's such a backlash, and they're like, oh, we'll roll it into our big plan. There's such a backlash that we have ended up taking over several of those big plans because like, God, what are you guys doing right here? So you listen, if you help people, you're going to help yourself, right? And that's pretty simple. And we are really, we probably have a higher margin than most do in the industry. And we do charge more because we do more. It's like, I remember competing on a case and they're like, wait a minute, you're going to make $125,000. We're only charging $35,000. I go, you're doing 4 committee meetings a year. We're going to 60 locations twice a year. Do you want to break it down to an hourly rate? Because we're wildly underpaid. And so it's, and by the way, we lost that deal. He won, but either way. But ultimately, if you are building those relationships, you're going to have an impact on their well-being. You're going to have an impact on them in their personal lives. You're going to help them. You can help them generationally. If you get someone on track for retirement, you get somebody in a good financial spot, their kids learn from that. Their grandkids learn from that. They're happier in retirement. This is not table stakes stuff. This is real impact stuff. And you're going to make more money because you're going to end up getting all their business whenever they have needs, because they're going to trust you as they should, as long as you don't misuse their trust, right? So
yeah, well said, man. Well, I want to pivot a little bit. So we've talked kind of about the past. We've talked a little bit about the present. I want to talk about the future a bit with you. So I always ask people to get out their crystal ball. So from where you sit, you have this great perspective on where things are going with Prime, but also the industry as a whole. So, maybe 5 years in the future, however far out you want to go. What do you think the future of this industry looks like? Where's it going? Where's it trending?
I'm an optimist. I think that technology and AI will help us. Like people are like, oh, they're going to take our jobs. Like people want to talk to people. People will always want to talk to people. People want to have their guide, someone that knows them inside and out. They want a personal relationship with them. So I think what it will do is make us better. I think it will take away the minutia and allow us to spend more time on the client, maybe earn more business. I think it's going to be good from that standpoint. I think you're going to see this convergence finally happen that everyone's been talking about between wealth, retirement, but not just wealth, retirement, like kind of full scope. You're going to help them with everything, think about it. Why aren't my clients buying auto and home insurance from us? Why aren't they doing their taxes with us? That's where it's going to go, right? It's going to all end up where we're going to be doing everything for them. So I think that's a natural thing that anyone could tell you, but I tend to be more optimistic that we're going to end up being able to provide more help because the technology is going to free up our time.
Yeah. I'm in the same camp. I am bullish on AI because I hope that it provides a bit of I call it a renaissance moment or something, right? Where people can focus more on artistic things, or they can focus on relational things or whatever, rather than, pushing data around or, all of those types of things. I think AI can help us get rid of a lot of the tedious things about our work so that we can, do more of the deeper relational, personal things with our work.
Yeah, I agree.
Awesome, man. Well, I could talk to you for hours, but as we come to the conclusion of this specific episode, we always do a really fun segment, lighthearted segment here that I call the Milemarker Minute. So I'm going to ask you 3-4 questions here. The goal is to try and answer all of them in less than a minute. So a little bit of a lightning round session here. Get to know Scott outside of Prime Capital and some of the things that you like outside of this. So you ready for the Milemarker Minute?
Let's do it.
Awesome, man. All right. So my first question for you is, if you were not in the financial services space as a career, you couldn't be an advisor, what do you think you would be doing in a different career with your work?
Probably a sports agent.
Sports agent. That's awesome. We'll have to talk about that offline. One place that you would love to travel that you've never been to yet?
Portugal.
Oh, Portugal. Go back to the family roots. You got to go check that out. That's awesome. Yeah. Best book that you have read in the last 12 months?
Synchronicity is near.
Synchronicity is near. Okay. We'll put that in the show notes for everybody. And then when you're not working, what would people most likely find you doing hobbies wise or something like that? How do you spend your time when you're not in the office?
My wife and I love finding great restaurants, and I've really started to develop passion for golf. So probably those two things.
I love it. This is outside of the Milemarker Minute, but your favorite restaurant in the greater Kansas City area?
Farina, Italian place.
Farina. Okay. I love it, man. Awesome. Well, you got through it. You nailed it. I think that was right at like 58 seconds. So even with some of my commentary, awesome job, Scott. This was a really, really great conversation, man. I think you dropped a ton of insight, not just for me, but for the audience as well. So I appreciate you coming on.
Yeah. Thanks for the opportunity. It's good stuff. I enjoyed the conversation. It was a lot of fun.
Thanks, man. I'm glad to hear that. Okay, everybody, that's been another episode of The Connected Advisor. Please make sure to click follow or subscribe wherever you're listening or watching this so that you can always be aware of when the next great conversation like this one comes out. But until then, have a great week and we'll see you on the next one.